Welcome back to this channel. This is Business Nerd Podcast. I hope you guys are having fun in the current market because the market is really good. Now, if you're new to this channel, I host Business Nerd Podcast where people come from different industries, entrepreneurs share their stories, how they've built a business to help you guys build a business. And the current series that I recently started, what you're watching, Business Nerd Podcast, Stock Market series, I wanted to share my point of view of the current market, my ideas, my thesis, to help you guys how to navigate in this current market. Now, if you're from the stock market community, I really hope I could bring you some value in this episode. If you're from a different field, I'm trying to bring different guests from different fields, and I hope those help you in your field. So in this episode, I'm going to cover a lot of different topics. The first one is I wanted to touch upon last episode that I had shared, some updates on that. I shared a lot of ideas. If you guys haven't watched it, I talked about what was going on in the current market back then, which was like 2 or 3 weeks ago, and then shared about something related to the Chinese market. I anticipated that there could be some announcement from China, and that was a major reason that we are seeing this bull run right now. The Chinese government announced rate cuts for $5 trillion worth of mortgages, which is like a really big news. Now, because of that, the housing market is going up, and followed by that, there is a lot of downstream impacts in like commodity markets, metals, and a lot of different industries related to the housing. If you guys haven't watched that, I want you to check it out because that is going to have ripple effects in the current market condition. That's not just a temporary phase that we are seeing, this current bull run. There is a lot of valid reason that's behind this bull run that we are seeing, because 3 weeks ago we had $1 trillion worth of crash. Suddenly the market goes up. So there has to be a strong reason behind it, right? So I've shared a lot of those ideas in that video. Go check it out. Now, also in the previous video, I shared that because of the Bajaj Housing Finance IPO, there could be balancing in the housing finance category, like valuation balancing in the housing finance category. Let's say Bajaj Housing Finance is trading at 7 book value, right? Now, price to book value. Now we have other finance companies like Home First, Avas, they are trading at sub 4, sub 5 number, right? So there could be some sort of balancing in that category. We saw that PNB housing ran up 60-70% in the last 3 months itself. That could be a huge trigger, by the way. So we can't really pinpoint why those stocks ran up 60-70%, but you can say that investors anticipated that there could be some sort of value balancing in that category. So I shared those ideas. Go check it out. It will be useful in the long run as well. Maybe not now because these stocks have run up, but do check it out. In this episode, I wanted to touch up on a few topics. What is actually going on, right? Because on one side, we hear valuations are very expensive. On the other side, we hear like all these companies' stocks are going up every day. Like we're not seeing any sort of relief after that. And when we see some relief, we hear all these negative news flow, like there could be a recession, there could be some stagflation, there could be a lot of different things going in the market. So it gets very difficult how to decide in this current market. Even for me, even for the investors like mutual funds, it's difficult to make decisions around when the atmosphere gets so complex to understand. But the underlying thesis of long-term investing will always remain. The only difference is how do you analyze your risk in these current market conditions. The next trigger, like Chinese announcement, right? So let's assess the impact of this sudden change that we saw in the market because of the Chinese government announcement. So what's the impact of it? From my understanding, like the impact is huge because the commodity markets are just entered in the bull run and it is going to continue for a very long time. I'm hearing that this is going to be a super bull run for commodities. I cannot say for how long it will sustain, but I saw this trend somewhere around August or September in 2023 when the dollar index was crashing. I put out a reel saying that commodities will run up because dollar index was showing signs of weakness, and like dollar index and commodities kind of have an inverse relation. So that is still playing out. Like commodities, if you can check it out, like dollar index today hit a new low, right? So you can see if I put out a month-on-month data, last time dollar index was this low was in 2022, which was 2 years ago. Close to 100, but this is not something that you should take it like lightly, because if it crashes, dollar index crashes, the commodity markets will run up like immensely. Super bull run. It could be wrong, but I see this current bull run in the commodity market as like a decadal opportunity for investors. We should participate in it. I'm participating in this commodity bull run. All the metal companies that I'm bullish on, like I cannot name those stocks, but I'm in general, broadly, if you look at top 3 or 5 companies, majority of those stocks will run up because of this bull run. That's what I believe, and I'm going to stand by that as long as I see this theory in check. Let's also look at one theory that I was looking at from Nuvama, right? Nuvama put out a report recently and they shared that investors should be cautious of the current market conditions, and like past cuts did not lead to immediate equity boosts. We are very bullish on like Fed cutting rates. We're anticipating that the Fed could cut rates up to 50 basis points or maybe 25 basis points, who knows. All right, so in 2021 rate cuts it was weak, till 29 it was weak, and the current it's weak, right? And like US full-time jobs, like year on year we saw growth of this, like current in this rate cut cycle it's in negative. So overall you can see commodity prices, let's verify that in this cycle it was weak, and then we saw what happened in 08, 09, right? In 2007 you can see after this it was very strong. This cycle it was weak. Like I anticipate that it might change in like 3 or 4 quarters because the prices of commodities compared to the valuation of the companies, it's not really that much. When you see commodities, I'm bullish on commodities in general, like metals, base metals, oil, petroleum, coal, like all these commodities are going to run up. Then we saw domestic demand. Like what about domestic demand of India? Like that was weak. Then in 07 it was strong. Right now it's mixed to weak. So we cannot complain that much that it's bad. Right, it's sort of rural is coming back. We saw how FMCG stocks have run up. That's still in a positive trajectory. Like the rural demand is coming up, and we suddenly saw a rise in like a jewelry and diamond segment because of some announcement from the finance minister. That could be another reason, but right now we're like fairly in a decent place in terms of demand. Some sectors, by the way, like some sectors are really bad, like apparels, garments, then like certain categories and chemicals. We have not seen major shift in demand because those sectors are struggling right now. Like I've heard a lot of commentary from these sectors. That's not very good. So far, we're like in a decent place. If we look at valuations, that is very high, right? That's very, very high. We have not seen those valuations like even in 08 kind of a bull run. Market cap to GDP is at all-time highs. Like this is not something that I would take it lightly. Then we can see performance of Nifty. Market performance in Nifty up to rate cuts was negative 25, then 40, moderate in -5 in like 19, and then we saw in 2024 it's at 25%. Like it's still not bad. Like the returns are not as much as we had in 08, but still when we look at other metrics, corporate earnings are not that good. It's still picking up. Like it's still picking up. Because of these rate cuts, we might see sudden bull run in the market because that's what everyone is hoping for. So that's not how things work. Like we have to understand how the market reacts to these rate cuts, and then we'll always understand in hindsight if the markets liked it, if it's going to have a major impact on the global markets or like even in the domestic markets. They shared a warning sign. Nuvama drew parallels between today's cyclicals, which is industrials, PSUs, autos, metals and IT stocks in 2001, which suffered the most after an initial surge. Similarly, cyclicals were hit hard in 08. Given their significant outperformance over the last 18 months, cyclicals are now seen as vulnerable to correction. When we say cyclicals, it means that they're talking about industrials, PSUs, autos, metals and IT stocks. Now that's their opinion. I don't fully agree with that point because I'm bullish on metals, IT stocks, autos, PSUs, not too much on the industrials, but still, that's just my view. They recommended reducing exposure to these sectors. Advised positioning portfolios with a strong bias towards defensive such as cash cows, insurance, telecom, pharma, consumer tech. I agree with them. I agree with this point. Like during such cycles, we should not play it too risky. What I mean by risky, it is that we should not be thinking of investing in capital intensive stocks, don't have asset light business model. They require a lot of cash to operate the business. Those are the sectors that I would stay away from at this point, because I am kind of a little bit hesitant on putting my money into these sectors. On the other hand, capital intensive businesses, like let's say in the PSUs, they have strong order books. Those are fine. Like I am bullish on like a lot of PSUs. Like I'll give you an example, NBCC. It has a strong order book. RVNL has a strong order book. Orcon has a strong order book. But these stocks are correcting. In the long run, I'm very bullish on these kind of stocks that have huge potential to grow because of the government's focus on infrastructure spending. They are trying to monetize a lot of their assets. In the long run, I'm very bullish on those stocks. Medium term, still bullish. In the near term, we might see some sort of hit in that category because of these rate cuts. You can get these stocks at a cheaper price if you're not in a rush to buy them. So where to invest now, right? So they shared a look at insurance. Insurance has already gone up, but still it's a fairly, those stocks are trading at a fairly decent valuation. Pharma looks good. I'm very bullish on pharma since 2019, not just now. Still has not done well, but like I'm still taking that hit. I'm very bullish on pharma, by the way. After the second wave of COVID, it has not done well at all. I've lost a lot of opportunities because of that, but still holding on to it, being optimistic. Consumer sectors, right? Like I said, FMCG companies are doing really well because of the rural demand being picked up, right? Private banks. Like this is something that I'm going to hold on to the end of this video because I have a few data points. I have some ideas to share on banking stocks, right? From this Nuvama report, I can tell you that valuations are very expensive. Financial companies in terms of banks, they're cheap, but I'll get into that. And then look at companies that provide any sort of safety net if the market corrects, right? Because we don't know what's going to happen. If there's sudden announcement from like China, if there's sudden announcement from the US, for them, like a crash of $1 trillion market crash is not that big because they're recovering like in a week, in a month. But for us, those tail effects, they will sustain. So we have to be cautious in terms of investing. That's the valuations. What about mutual funds? Right? Because mutual funds, those are the smartest guys in India, right? So Parag Parikh, like I really respect them. They shared that they are okay with missing out opportunities in this market. Like they don't want to outperform the index in the current phase that we are in, which is I kind of agree with. Don't have to take a lot of risks because there's a strong chance that the market may correct. The risk reward ratio is not favorable because the downside risk is a little bit higher than what we see in the upside. I'm thinking in terms of I want to stay in the game for the long term. I don't want to just make money in like 2 months and then not look at the markets at all. Like I'm in it for the long term. I don't want to rush into this euphoria and like make a hasty decision, regret it 3 months later, and then my capital goes down. So that is my understanding. Like mutual funds have sold, even in the private banking space, mutual funds have sold HDFC Bank. So you can imagine like the biggest bank growing at the fastest rate, 20%, like I'd say, and they're still not betting on it. Either they're chasing momentum or they see some sort of correction on the market. That's just my understanding. I don't know what's going to happen in the private banking space, but like I said, mutual funds are selling in that space. They're buying into stocks like pharma, then they've bought IT recently, Infosys they recently bought, FMCG players, but the highest one that I saw was they're trying to shift in the large cap, what I'm doing as well. So that's what I see in the mutual funds. On the other hand, we have another sector that's trending, which is solar, right? We had amazing companies IPO, which was Premier Energies, listed really well, gave a lot of listing gains. What about in that category? Because solar is one category which is growing every month because of government's push on rooftop solars. The sector has been receiving a lot of positive traction. Wind energy, a lot of renewable energy projects are being awarded in the market. So how do you assess that? So I'm very bullish on solar. I wouldn't be comfortable buying solar stocks at this point because they're still expensive for me. On the other hand, we have other financials in the solar space like PFC, REC. Those are trading cheap. They are not expensive. If you look at the valuations of, let's say, PFC, right? So PFC, Power Finance Corporation, is trading at 7.81. Like one of the best NBFCs in the power space, trading at 7.81 valuation. Their book value is 306. Price to book is not that high, right? And if you look at its peers of, let's say, REC is its closest peers. It's trading at 10. Even REC is cheap at 10 P. Although it's a nodal agency of this current scheme, but Power Finance Corporation has a strong order book. The NPAs are not that high, and like they're growing at a decent pace, right? So quarterly profits are growing at 21%, higher than REC. Their net profit is more than REC. Their market cap valuation is like a little bit close to REC, but still valuations are cheap. I'm very bullish on on PFC. And other sectors like in the railways and other stocks, railways have come off from their highs. Let's accept that fact. Like they've come off their highs. I don't know how strong their like execution is because I'll have to read their management con calls. But the government is still pushing infrastructure spending in the railways. Not that fast because it's a coalition government. I don't know that what's going to happen behind that. So that has cooled off. Maybe that's the reason that government's execution has cooled off. The investments have been announced. They're announcing new MOUs. They're announcing new investments in this space, but the execution is the problem, I think. So the stocks have come off. It can pick up from here, but we'll have to closely track how the government executes. So that's China, that's solar, that's railways, that's infra. We covered rural demand. We covered US Fed, like rate cuts. So what's the next outlook looking like? Like what's the next thing for India given all these factors? So the next thing that I would be closely watching is like US rate cuts. Like that's in this week. If you're new to the market, like check out this like website called Forex Factory. That's where I view all my data when we look at oil and all these US GDPs, non-farm payroll data. So this is where I look at. If you don't know, like this is the tool that I use. Go check it out. You may not understand it like initially, but once you get the hang of it, you'll understand, oh, this was the reason that like the consumer price index was low and then the industrials stocks crashed. The manufacturing data was bad. All the cement and other companies crashed. Suddenly the oil inventory went up, crude crashed, ONGC, Oil India crashed as well. So it's heavily connected. If you're new, like learn how to read this data. I cannot explain you in like 5 minutes, but I can just give you a gist of it. Like this is how things go. So look at this website, track the government, track the data that we see. More importantly, I'd be looking at tone of US Fed and the elections in the US that we have. I have zero understanding of politics, so I don't comment on politics at all. But that's one factor that affects the market. So we have to look at it. I don't know who's going to win, but most likely if Trump wins, we're not in a bad place. Then there is OPEC. Like you've seen how crude has come off. So Brent is at $73 at this point. Today it's up. But if you look at monthly chart, let me just pull up daily chart. You can see it has crashed recently from, like you can see this is July month. It has crashed from 86 and it made a low of 69, which was below 70, and it broke like 2021's record. Like the last time it was below 70 was in 2021. This is the current market that we are in. Crude is coming off, which is good for India, but there's one problem that we don't analyze. It's OPEC. They hate when crude prices go down. Like they'll push back on the supply. They'll try to control the prices. They'll want the crude prices to go up. If we see a sudden rise in crude, like let's say 10%, Indian markets will crash from there because we are heavily dependent on crude, first of all, although we're buying from Russia, but that naturally affects the Indian markets. Crude producers will benefit from it. OMCs may take a hit. If you haven't watched, by the way, on OMCs, I made a video. I actually made a lot of content on this. I am very bullish on commodities in the long run. That's a fact, like I shared in this video. The next thing that I'm very bullish on is OMCs. Dirt cheap valuations, well-managed companies. They are generating enough profits for the government to like invest more in new capacities. So I really believe that OMCs could be the next big driver for the government to generate growth, and like government's going to push a lot of investments in OMCs, just like we saw in like railways infra that we had in last 1 or 2 years. OMCs can be the next thing for the government. Unlike all these infrastructure like railway companies that didn't do well like 2-3 years ago, Like they were not generating those kind of profits that we are seeing right now. This is the current market that we have. The organic growth of these OMCs is so huge that they don't require any sort of inorganic funding from the government. They have rewarded shareholders immensely. So I'm very bullish on OMCs, right? There are three sectors that I shared earlier: OMCs, engineering R&D, FMCG. Still stand by those sectors. I'm very bullish on three of them, but if I had to pick just one of three, it'd be OMCs. Watch out for OMCs because that will be our next big driver. Now, when we look at next growth cycle, as we are talking about, crude is one major thing that you should track. Like, I hope you found this useful. I'm trying to do more of these videos of trying to dig deep in these like stocks, that research that I'm doing, talk about what's going to affect the stock, the sector from different angles, trying to give you my point of view of how I see the market. If it helps you guys, do me a small favor, hit that subscribe button, leave a comment, hit that bell icon so you don't miss out on these videos, because even a small news flow can help you make the right decision. That's what I believe that has helped me so far. Like even a small news flow has had massive impact on my portfolio. So I'm trying to do a lot of these solo podcasts, by the way, the Business Nerd podcast, stock market series. I'll be sharing a lot of stock market videos here. If you're also from business community, if you're trying to build some businesses, I've had a lot of guests from different industries like real estate, marketing, and other industries who have shared their stories to help you guys how to build a business, how they build a business, how they're trying to navigate their market. So I kind of like to learn about those kind of businesses. So that's the whole point of this podcast. Like I wanted to have one show where I can invite those guests and I can share my input from my work. So if you guys enjoyed this episode, leave me a comment, hit that bell icon, let me know what you're doing in the stock markets, how you're seeing the market, how you're navigating, what are the investments that you made, and best of all, did I help you in any way? So I'd love to know. Until next time, peace.